Hi, it's Andy Hoffman, Media Director of Miles Franklin Precious Metals in our 25th year in business. It's midday, Thursday, October 2nd, and this week's audio blog is titled Countdown to the Yellen Reversal, which, given the breakdown in equity markets that the PPT is having trouble controlling, could be much quicker than people assume. As reliably as night follows day, money printing always yields exploding debt, stagnating economies, and hyperinflation. And today's modernized euphemisms for such, like ZERP, QE, or in Goldman Mario's words this morning, private QE, are no different. In fact, unlike the previous 600 failed fiat currency regimes, today's is the first to encompass the entire world. Consequently, the fate of one is the fate of all, and as we have emphatically realized in the current system's terminal stage, reserve currencies, like the dollar and euro, export massive inflation to the lesser 180 currencies or so, the result of the final currency war we have long described. In other words, as the aforementioned inevitable economic collapse expands, all central banks increase money printing, aiming to devalue their currencies with the purely political agenda of, quote, creating jobs. In reality, such gains are but a figment of politicians' and bankers' imaginations, as exemplified by America's lowest labor participation rate and manufacturing market share in 4 decades, or for that matter, the utter collapse of Japan's economy despite nearly 2.5 years of Abenomics and a plunging yen, and Europe's economic implosion despite 2.5 years of Draghi doing whatever it takes. And even in the rare instance when corporations do in fact achieve such benefits, the resulting profits are destroyed by inflation, which, by the way, millions of citizens earn as well, with nothing to show for it but plunging standards of living and surging debt loads. Today, financial markets have so dramatically separated from economic reality, it makes 2000 and 2007 appear to have been normal. And no, I'm not using hyperbole, as valuations, leverage, and sentiment are well above the peaks generated during the late 1990s internet mania as well as the mid-2000s real estate bubble. I didn't think I would ever see such madness again, but this is what occurs when money printing follows its preordained course of exponential expansion. The fact the post-Glass-Steagall world has spawned unparalleled weapons of mass financial destruction as well to abet the process, such as OTC derivatives, high-speed trading algorithms, and unprecedented utilization of plunge protection operatives, has widened this gap exponentially, not to mention the gap between the finances of the 1% and the 99%. The resulting stagnation and inflation has catalyzed global social unrest and geopolitical tension not witnessed since World War II, as the global debt edifice parabolically surges toward the heavens. The ancient Greek myth of Icarus flying too close to the sun comes to mind, and as even the world's most sociopathic bankers realize, man is no match for Mother Nature, and equally so, economic Mother Nature. I've often been asked what will catalyze the inevitable endgame of worldwide fiat collapse, led by the reserve currency status of the US dollar. That answer cannot possibly be known, as any number of black swans are capable of doing so on their own, irrespective of the aforementioned factors. Of course, the fact that so many potential black swans are swimming around is a direct result of said money printing, so at times it can be difficult to isolate them. However, whether referring to MF Global, Cyprus, the Ukraine, Hong Kong, Ebola, Catalonia, Spain, or the Swiss gold referendum, among others, the list is as broad as it is long, and irrespective, the horrendous weight of the dying economic system could do it all by itself, as evidenced by the past few weeks' breakdown of global equity indices. No, they haven't collapsed as of yet, largely due to unprecedented levels of market manipulation, particularly in the precious metals market. However, the signs that unparalleled strain are plainly evident, as exemplified by the fact that more than half of all U.S. stocks are in certified bear markets, despite PPT-supported indices like the Dow Jones Propaganda Index hovering near all-time highs, unadjusted for inflation and survivor bias, of course. In fact, the U.S. new lows to new highs index is at its highest level since just before before the December 2012 commencement of QE3, and highlighting what we wrote 5 months ago in the most damning proof yet of QE failure. U.S. interest rates have badly broken down despite the Fed's best efforts to portray recovery. Eventually, hyperinflation will destroy all global bond markets, and particularly the historically overvalued U.S. Treasury market. However, until that day, we continue to emphatically anticipate Western yields plunging to zero or below as the worldwide investment community front-runs QE to infinity. All-time high debts guaranteed the Fed, ECB, and other central banks, including the PBC, by the way, must maintain record low interest rates, and plunging economies equally guarantee the same tired response, particularly when bankers own central banks, as is the case with the Fed. So again, you ask, what will be the catalyst that lurches the world into the big one, which can't be reversed by money printing? To that, we confidently answer that, outside the obvious disruptive effect of a major black swan event, it will unequivocally be the Yellen reversal, when, after years of propagandizing recovery and manipulating markets to purport as much, whirlybird Janet is forced by the markets to admit the U.S. economy is wilting, and of course, respond in the same manner as always by increasing QE. Trust us, it's coming, by hook or crook. As for the week's horrific headlines, the massive pro-democracy protests in Hong Kong are particularly troubling for the global elites. And by the way, yet another reason the common knowledge that Chinese territories are the safest place to store gold may be altered. Holding my gold in Miles Franklin's Brink facility in Montreal, I feel far more protected from political risk than halfway around the world in communist territory. And hopefully, those storing gold in the world's far reaches consider giving our offshore storage website a gander. Of course, Hong Kong is but one of many spreading geopolitical wildfires, from the Ukraine to Argentina, the Middle East, and Russia, among others. And economically speaking, which is what the Miles Franklin blog focuses on, said wildfires are more like blazing infernos. In China, we learned that land prices have fallen an astonishing 50% year over year, as history's largest real estate bubble rapidly bursts. No wonder the PBOC has announced 2 QE rounds in the past month, and if you think more aren't coming soon, we have a bridge to sell you in Brooklyn. In Japan, industrial production utterly collapsed, as did real wages for the 23rd straight month, as the horrific stagflation spurned by Abenomics rapidly drives the land of the setting sun into the abyss. And in Europe, where said private QE is commencing now, Germany's PMI manufacturing reading plunged below 50, indicating the continent's supposedly strongest economy is now in recession. And if you think that's bad, just wait until the money printing really kicks in, as well as the demographic hell rapidly approaching the West like a runaway train. And of course, the recovering states of America, where a plunging Case-Shiller housing index, and for that matter, home building equities, dramatically emphasize what we wrote in last week's Housing Recovery, Rest in Peace. This week alone, consumer debt levels surged. The Chicago PMI and ISM manufacturing indices plunged. While consumer confidence had an historic monthly decline, the aforementioned Case-Shiller index fell for the third straight month, mortgage purchase applications stagnated at 14-year lows, construction spending unexpectedly plunged 0.8%, and factory orders imploded by 10.1%. All that's left this week is tomorrow's NFP report, i.e., the epitome of the U.S. government's island of lies economic reporting. As we wrote in yesterday's Painting the Tape, this will be the last NFP report before the all-important midterm elections. Oh, not important to America, but to its politicians. And thus, we wouldn't be surprised with any fabricated number, particularly given the powers that be's desperate need to reverse the expanding equity implosion. Unfortunately for them, September is one of the few months in which the birth-death model is typically negative. So it will take a big accounting chicanery change to produce a big number. Oh well, I guess they'll just have to double up on the increasingly ineffective propaganda, such as Yahoo Finance's comical top headline today, i.e., Buffett, I bought stocks in Wednesday's big sell-off. LOL, can you believe the financial markets have been so badly broken by years of QE and government market support that we are conditioned to believe a 1.5% decline from record levels is a, quote, big sell-off. Of course, now that retail participation has all but disappeared from the markets and underperforming hedge funds are folding like bad poker hands, the adage of, if a tree falls in the forest, does it make a sound, comes to mind. As for the precious metal markets, in this week's Crescendo, we wrote of how something big appears to be on the horizon. And I won't go into it now because it would take too long, but clearly the separation between physical demand and paper prices has never been wider. In today's Here Comes the Physical Buying, it depicts how global physical demand is surging. And in yesterday's historic capitulation, we wrote of the myriad signs that the cartel's most massive paper raids to date appear to have run their course. For these and countless other reasons, from the pure economic to the black swan variety, we cannot be more emphatic in our belief that this may be your last chance at financial survival. And for those taking the initiative to protect yourselves with physical precious metals, we hope you'll call Miles Franklin at 800-822-8080 and give us a chance to earn your business. And as always, I can be reached via email at ahoffman@milesfranklin.com. Thanks and have a nice weekend.